Today is January 13th. This is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, Mark Bowman, and JP Steiner, all from the ADMIS research team. And starting with the grains this morning, Mark Soderberg, what stood out the most to you in yesterday's USDA reports?
Yeah, I've long felt the January USDA reports were amongst the most important USDA reports you get out of the course of the year. Not only do we get the final production figures for last year's corn and soybean crop here in the U.S., but quarterly stocks information shows us, calculates some other domestic usage figures. We also get updated supply and demand figures, both domestically and globally. And finally, we also get our first glimpse into the USDA's winter wheat acreage forecast as well. So amongst all that data from yesterday, what stood out to me the most was the fact that the U.S. corn yield increased only half a bushel per acre to a new record 186.5 bushels an acre, but it did so with yields being cut in our three largest producing states. Iowa yields there were cut 6 bushels an acre to 210. Illinois was down 7 to 214. And Nebraska was down 3 bushels an acre to 194. So other important states saw reductions as well. Ohio was down 9 bushels an acre, while Indiana was off 2, still over 200 at 204 in Indiana. But so obviously we have other states that saw yield increases as the national average did tick up a little bit. These primarily came across the far north and in the deep south. In Minnesota, our fourth largest producing state, yields there that jumped 8 bushels an acre. Wisconsin, they were up 5 bushels an acre to 188. North Dakota, that was up 12. And then looking off into the south, Texas, they were up 5 bushels an acre to 135. And Louisiana, that rose a whopping 17 bushels an acre to 193. So all in all, we saw a large number of states see yield changes from what was forecast in November. So much more changes than you're accustomed to seeing in this January report. I think it possibly just had something to do with the fact that the longest federal government shutdown in history was last fall. So I think that really kind of crippled the USDA daily operations. So a lot of changes there.
And Mark, where do you see corn and soybean prices headed with this USDA data now out of the way?
Well, relative to expectations, yesterday's USDA data was bearish for both corn and soybeans, probably more so than corn than anything. I think the record yields and higher than expected stocks for both, combined with favorable weather in South America, I think we're really going to limit the upside potential right now. I'm afraid yesterday's 3 million metric ton increase in South American production on the soybeans, which was all in Brazil, is only just the beginning of what's going to be further increases down the road. So I do think it's going to make even the reduced USDA export forecast in beans of 1.575 billion bushels even more challenging to attain. China does appear to be close to reaching the 12 million metric tons of U.S. soybean purchases they agreed to buy last fall. And after that, I would look for all of their demand to shift to South American origin, as that's running generally between 60 and 90 cents a bushel below the U.S. So I look for spot soybean prices to probably pull back into that 10 to 10.25 range. U.S. corn exports probably going to remain strong into early spring. However, here with just under the weight of a 17+ billion bushel crop, I look for corn prices to pull back as well. The contract low on the spot contract is 410. I think we'll challenge that. Won't even rule out a challenge of that $4 level or just below that. It's through the first quarter of this year.
Thanks, Mark. JP had some inflation data today. What did that tell us?
Today's inflation data showed that prices for goods and services rose 2.7% on the year in December, holding steady from a month earlier and in line with forecasts. The Consumer Price Index report showed that the impact of tariffs is still relatively muted and does offer a measure of relief to Federal Reserve officials who lowered rates last month. Core prices, which strip out food and energy prices, rose 2.6% on the year, also unchanged from November. On a monthly basis, prices rose a seasonally adjusted 0.3%, while core prices saw a 0.2% rise on the month in December. A number of key household items saw large price increases over the month. That would be groceries, restaurant meals, housing costs, transportation services, and medical care also accelerated in December. However, helping to rein in the headline number were gasoline and used car and truck prices that saw a decline. November's inflation number that was released a month ago might have been artificially low given a technical fix to the data collection efforts as a result of the government shutdown. As a result, economists had cautioned that the December reading released today would likely reflect some payback for an understated November figure. So given that there was not a notable jump in prices or a lack of an upside surprise, I am sure that was met with some applause by policymakers at the Fed. That being said, Fed Chair Powell said he does expect inflation to peak in the first quarter of 2026 before subsiding for the rest of the year. So I would be a little cautious to celebrate this as a confirmation that prices are starting to head lower. But however, given the lack of an upside surprise and sort of a stabilization in prices, I think it's a welcome reading for sure.
JP, currently the markets are favoring 2 rate cuts this year. What is your prediction for that Fed policy?
Yeah, so right now markets are favoring a cut in June or July, and then another one in the late end of the year, while the Fed's latest dot plot revealed that policymakers' median expectation was that the bank would cut rates only once this year. Today's inflation data unlikely to change those expectations much between the Fed and markets. Fed officials are likely going to need to see either new evidence that job market conditions are weakening or that price pressures are fading, and that could even take a couple more months of inflation reports for the latter to materialize. As for the jobs market, most indicators are pointing to a stable labor market with subdued hiring. December's report showed the economy added 50,000 new jobs. That was below expectations, but also saw a downtick in the unemployment rate from 4.5% to 4.4%, reinforcing the theme of a low hire, low fire environment. JOLTS data for November revealed that many other indicators were also stable. The quits rate was 2%. That was in line with recent trends and signaling that employees feel less mobility in the labor market, given that it does remain below its 2019 average of just under 2.5%. When the labor market is healthy, workers do enjoy a stronger sense of job mobility in search of better job opportunities. Consequently, that dynamic drives wage growth and economic momentum and also signals a healthier labor market. So it being below that trend is a little worrying, but not too much. And given the layoffs rate, which measures involuntary separations initiated by the employer, that was little changed in November and also in line with figures from the past 4 months. The layoff rate edged down in November to 1.1% from 1.2% in October. That's a positive sign and signals a labor market that is stable. The layoffs rate is also well below its pre-COVID average of just 1.5%. These are just a couple of dynamics to point out regarding the labor market. Personally, if I were a voting member at the Fed, I would like to see some more progress on inflation before I would consider thoughts on lowering rates. Personally, I think the Fed funds rate is relatively neutral to financial markets, and unless there's a rapid deterioration in labor market conditions, I don't think there would be any need for it to fall anytime soon. However, looking at the Fed, Powell's term ends in May, and a chair who is likely to be favorable to lowering rates will take his place. As well as Fed Governor Moran's term is over at the end of January, and his replacement is likely to be a permanent member, also with a more dovish-leaning stance. Everyone else voting at the Fed this year has been leaning a little bit more dovish to neutral as of recently. However, a new influx of regional Fed presidents should balance that out a little bit. But I would say that that's the case where the Fed is definitely leaning a little bit more dovish to neutral. So it's definitely the case that the Fed's meeting projection could be revised to 2 cuts. In my opinion, I see 1 cut as being guaranteed and a second cut probably happening later in the year if we get a cooling inflation picture heading into the summer.
Thanks, JP. And last but certainly not least, Mark Bowman, what is the outlook in the cotton market in the wake of Monday's USDA supply and demand report?
Yeah, so the report was a bit of a bullish surprise. They had production, U.S. 2025-26 production, 13.92 million bales versus an expectation of 14.2 million. And that was down about 350,000 bales from the December update. They left exports unchanged at 12.2 million bales, which was a bit of a surprise given the slow pace of U.S. export sales this year. The most recent export sales data showed cumulative sales having only reached 59% of the USDA forecast versus a 5-year average of 76% for this point in the marketing year. So if that pace continues to drag, one would expect the USDA to ultimately lower its export forecast. Yesterday's report did put ending stocks at 4.2 million bales, which is down from 4.5 million in December. So a bit of an improvement. Stocks usage ratio now 30.4% versus 30.9% in December. Still above the 5-year average, 26.4%, and still the highest since 2022-23. So not a big change, but at least a move in a somewhat bullish direction, leaving the bulls something to lean on, but probably need to see an improvement in export sales. And next up, some indication of maybe lower plantings for the coming year based on the low prices. There are also suggestions that El Nino could reemerge later this year, which would raise some concerns about the weather.
Mark, flipping the page a little bit, there's a lot of unrest, throughout the world, really, and of course in Iran. How is that affecting the energy markets?
So this week, we've seen a pretty significant rally in crude oil this week, and the protests in Iran is one of the things that's being credited to. These protests were sparked by a collapse of their currency, but also by frustration with the government that's been building for quite a long time. These protests really seem to start among the shopkeepers who up to this point have been fairly supportive of the regime. It's not just young people concerned about personal rights this time. It's an economic situation as well. And the Republic already back on its heels after Israel and U.S. bombed nuclear facilities last summer, and their proxies, Hezbollah and Hamas, basically collapsed after their leaders were assassinated. On top of that, we have these sanctions, especially on the crude oil. Iran has estimated 50 days worth of production being stored on ships because their key buyers, China and India, have paused their purchases due to the sanctions. We also have the Venezuelan oil now in that basically being taken by the U.S., and the people charged with marketing that are talking to refineries in China and India about taking that oil. President Trump warned that the Iranian government publicly that the U.S. would respond if Iranian government killed protesters. Suggested this weekend that crossed that line. We're getting evidence of that this week, with reports of up to 3,000 people killed, and that other reports of government forces shooting at protesters. So the question becomes, what will the administration do? They are reportedly weighing options. Speculating that maybe could be more strikes on nuclear facilities or a cyber attack on domestic security forces. One of the things this raises concerns about potential blockage of the Strait of Hormuz, which out of the Persian Gulf, which is an export pathway not only for Iran but other Gulf producers like Qatar and the United Arab Emirates. Turkey may be concerned about natural gas supply from Iran through the pipeline there, which could push them into purchasing more liquefied natural gas. And there are concerns that if the Hormuz is blocked, and therefore you have LNG that comes from Qatar and UAE also being blocked. So there's a lot of heightened attention. One thing we do have to be aware of, though, is buying the rumor. markets tend to peak when bullish news peak. On the bear side, Iranian supply has already been disrupted, and you have all this oil sitting in tankers waiting to be distributed. And OPEC Plus could be in a position to expand their output further if needed to offset the losses to any losses to world supply. And both Saudi Arabia and other Arab producers are no big fans of the Iranian regime. So it's not like they would be reluctant to boost supply if they thought it could be taken. We do not expect a big supply production growth out of Venezuela, but they could be at least back to where they were before the sanctions and before the Maduro capture in the foreseeable future anyway.
Lots to watch. Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.